I'll start off with you. At this point, given all of these uncertainties that Powell so aptly listed in yesterday's testimony, what can a 25 basis point cut actually do at this point to the rally? How much more can it extend stocks?
Well, I think it's more about sentiment. And I think, the markets got what they wanted to hear yesterday. But I do think at this point we've gotten a lot up front. It's been a pretty exhilarating first half plus for equities. So I think in order to fuel the next leg of the rally, we actually need to see a turnaround in the growth data, and we're really not seeing that as of yet.
Francis, you say that you can see the case to be made for going either way in terms of holding pat or actually cutting rates, even though Chair Powell went out of his way, it seemed, to sort of highlight the negatives now that he's seeing.
He certainly didn't seem like an optimistic guy yesterday. And while I could certainly say, uncertainties have come back over the last 6 weeks, business confidence is looking a little bit better at the margin. The point is that Chair Powell had all the time and all the power in the world yesterday to walk back market pricing for a rate cut, and he did not do that. And at this point, ignoring his messaging, you do it at your own peril. Do we discount to some degree the economic data that we're going to get ahead of the next Fed meeting? Because he said effectively to look through the strong jobs data that we got last week. Well, absolutely. And one of the key messages for me yesterday was Powell essentially said, I almost don't care that June number was a bounce back. I'm more concerned about the longer term trend. So I would have said at the beginning of the week, today's inflation data matters a lot. I would have told portfolio managers, you have to trade around that number. As of now, based on what Powell said yesterday, I don't think it'll move the dial at all.
Ed, what are we actually looking at, do you think, in terms of how we characterize this rate action by the Fed? They're talking about it being preventative. It seems very focused, too, on just trying to uninvert the yield curve, right? It's very conspicuous that the short end of the Treasury curve is sitting out there above 2%, and the rest of the world is way below that. Beyond that, though, what are we going to get? Is it an easing cycle, or is it just a little bit of a preventative measure?
I think it's, like you said, it's more about taking insurance against the downside risks. If you look at the Fed's base case, you would say that this cut is really not needed, but it's really insurance against the downside risk. So you mentioned the inverted yield curve. That's the one thing that's sort of flashing red on people's dashboards in terms of recession risks. But we're going to get initial unemployment claims later today. If you look at those, they're still around historic lows. If you look at high yield spreads and some of the other reliable indicators of recession risk, they're really not flashing the same alarming signal.
But what's your outlook for the year in terms of the markets, Ed, and how is that shaped by this view of what an insurance hike is? Because I would imagine that 25 basis points in and of itself isn't enough to be an insurance cut against a recession. I don't know if you think of it's more like a 95 sort of easing cycle where there are a series of cuts as preventive measures. So we think this is another growth slowdown. So I don't think it's the beginning of a big easing cycle. I do think the economy will eventually rebound. In terms of our investment strategy, we're right around neutral in terms of the major asset classes. So as I mentioned, we've gotten a lot up front, right? So if we look at our market sentiment indicator, it's indicating exuberance at this point. So I think we need to kind of digest the move that we've had so far. So we're cautious, but we're not bearish. I do think that the central bank dovish pivot that we've seen in the continued stimulus out of China is eventually going to turn around the growth data, and that's going to provide the fuel for the next up leg for risky assets. So we're cautious right now, but I don't think we've seen the cycle highs in terms of risk assets. When did you go neutral?
At the beginning of May, when
before the downturn, but then before the bounce back as well.
Right. So we did look prescient ahead of that downdraft in May, but we have missed some of the bounce back that we've seen since then.
Francis, the Treasury market, is it priced for continued slowdown? Does it seem like yields a little bit too compressed now? How do you play that? That
is the most important question. And in my view, you really have to pick one of two camps. Are we in the 1990s insurance cut environment, in which case you better be short bonds right now? Or are we heading towards an easing cycle? Are we heading back towards zero because, frankly, we're heading towards a 2020 recession? It's one or the other. And this idea that we're going to cut 3 to 4 times somewhere in the middle is probably not accurate pricing. In my view, this really is a 1990s situation. It's an insurance cut. But from a bigger perspective, absolutely. absolutely. I'm totally happy being a little bit short bonds heading into the next couple of months.
So if we believe that the Fed's going to continue to cut rates, not just a July cut of 25 basis points, what does that do to your expectations for cuts around the world? The ECB meeting is shortly after the Fed meeting. There's now a greater expectation that China will also join in on the party with an actual rate cut.
That's absolutely right. We spend so much time talking about Powell, but let's expand the lens a little bit and realize that almost every major global central bank is now easing. I'm expecting further rate cuts out of China. What does that mean? It means that global growth is going to get supporting. Easing works, maybe not to the same degree we'd like, maybe not when employment is so close to full employment, but easing works. We will see some stabilization in the global economy. And then, of course, if we have global easing, we should probably also be talking about some reflation trades.